Today we're breaking down ULTI, the REX IncomeMax Option Strategy ETF, an actively managed income ETF designed to generate frequent cash distributions by combining equities, options strategies, and short-term U.S. Treasuries. This is not a traditional dividend ETF, and it's not a simple covered call fund either. ULTI is built as a multi-engine income strategy, with the goal of delivering steady income rather than maximizing long-term price appreciation. ULTI seeks to generate income from three primary sources: stock dividends, option premium income, and interest income from short-term treasuries. The fund targets weekly cash distributions, which makes it especially appealing to income-focused investors who prioritize cash flow consistency. On the equity side, ULTI holds a narrow, actively managed portfolio of U.S. equities, typically ranging from about 15 to 30 stocks, or equivalent synthetic exposures created through options. Rather than selecting stocks based on traditional fundamentals alone, the fund uses a quantitative process to identify securities with high implied volatility and strong liquidity. These characteristics are important because they allow the fund to collect higher option premiums while maintaining efficient execution. The core driver of income for ULTI is its options strategy. The fund actively writes covered calls, sells put options, and uses call spread structures to generate premium income. By selling options on volatile and liquid stocks, ULTI aims to consistently collect income regardless of whether markets are rising, flat, or modestly declining. However, this income does not come without trade-offs. Writing options, particularly covered calls, caps upside potential if the underlying stocks rise sharply. In strong bull markets, ULTI may lag broad equity indexes because gains above the option strike prices are given up in exchange for premium income. This is a key concept investors need to understand before using this ETF. To help manage downside risk, ULTI does not rely on naked option exposure. Each written option position is paired with a lower delta purchased option, which helps limit potential losses during sharp market drawdowns. This structure is designed to smooth returns and reduce tail risk, but it also means the fund is constantly balancing income generation with risk control. In addition to equities and options, ULTI can allocate up to 10% of assets to short-term U.S. Treasuries or cash. These holdings serve two purposes. First, they act as collateral for option positions. Second, they generate interest income, which becomes more meaningful in higher-rate environments. From a portfolio construction perspective, ULTI is best viewed as an income-oriented allocation, not a growth ETF. It may fit well in portfolios focused on cash flow, such as retirement income strategies or income-focused taxable or tax-advantaged accounts. Investors looking for maximum capital appreciation or long-term equity beta may find ULTI less suitable. It's also important to understand that ULTI's returns will be heavily influenced by volatility levels. Higher implied volatility generally improves option premium income, while lower volatility can reduce income potential. As a result, distributions may vary over time, even though the fund targets regular payouts. The bottom line is this: ULTI is a sophisticated income ETF that uses equities, options, and treasuries to generate frequent cash flow. It offers multiple income sources and built-in risk controls, but it sacrifices upside potential in strong markets. For investors who value income consistency over growth, ULTI can be a compelling tool when used appropriately within a diversified portfolio. If you found this breakdown helpful, make sure to like the video, subscribe to the ETF Investor, and comment below. Would you use an options-based ETF like ULTI for income, or do you prefer traditional dividend strategies?